Hello everyone. I, Vanipriya Singh, Assistant Professor of Lakshmi Chand Golwala College of Commerce and Economics, will be discussing about accounting concept in today's video. So generally accounting concept comes under the subject financial accounting and becomes a part in the first module itself, that is introduction to accounts, for most of the courses. So today in this video, we'll be discussing about what the concepts are and what are the different concepts that are included in accounts. Basically, students' accounting concepts are nothing but assumptions. Those assumptions on which preparation of accounts takes place. Now, these assumptions are extremely important, so important that they lay down the foundation for preparing your accounts. So, I can say that most of the principles and the rules and regulations that we study are actually derived from accounting concepts and conventions. So today we'll be studying about concepts and the different accounting concepts. Generally, there are 10 accounting concepts that we will be looking into. Let's start with the first concept, that is business entity concept. Now, what is business entity concept? This concept assumes that for accounting purpose, the business enterprise and its owner are two separate independent entities. So the business and personal transaction of our owners are separate. Now, for example, let's take an example here. When the owner invests money in the business, it is recorded as liability of the business to the owner. Similarly, when the owner takes away from the business, let's say cash or goods for his or her personal use, it is not treated as a business expense. Okay. This is the first concept, that is business entity concept. I'll just say it in one line. This concept simply says that the person who's running the business, who owns the business, and the business are two different independent entities and they have to function differently. There is no involvement of transaction between them. Okay. Now let's go to the second one, that is money measurement concept. Now, this concept assumes that all business transaction must be in terms of money. That is, it can be in any currency of a country. Let's say in India, the currency would be in terms of rupees. Okay. Thus, as per the money measurement concept, transactions which can be expressed in terms of money are recorded in the books of account. For example, let's take, there is a sale of goods of rupees 2 lakh. Okay. There's rent paid of rupees 10,000. All these expenses can be expressed in terms of money. They have monetary value, therefore, they can be recorded in books of accounts. But those transactions which are important but cannot be expressed in monetary value will not be recorded in the books of accounts as per this concept. For example, let's take sincerity, loyalty, or hard work of an employee. Okay, loyalty, hard work, and sincerity of employees do impact the company's profit making, right? But such it cannot be expressed in monetary value, so such transactions will not be recorded in the books of accounts. Okay, so I'll explain again this concept in one line. This concept says that all the transactions that can be expressed in money simply has a monetary value. Only those transactions must be recorded in the books of accounts. Okay. So first we studied about business entity concept and second money measurement concept. Now let's go to the third one, that is going concern concept. Now this concept, which is going concern concept, speaks or suggests a business person or the person who's making his or her account to be completely optimistic. Okay. Now, when I say optimistic, I mean extremely positive when it comes to the lifeline of business. So this concept says that a firm will continue to carry on its activity for an indefinite time period. It means that every business entity has continuity of life. So you have to imagine, you have to make your accounts in a such a way that you have to keep in mind that your business is never going to be closed. You will always run your business. There's no date, there's no time period where you're going to close your business, or there's any shutdown period or shutdown point. Okay. With that kind of optimisticness and positivity, you have to continue building your business. You have to make your accounts like that. This concept is extremely important, students, while making your accounts, because look, let's take one transaction here. When we write closing stock in the asset side, okay, while we're preparing file accounts, we mention closing stock with this. We mention it in the asset side and we mentioned in the credit side of the trading account, with this mindset that the next financial year we will make sure we are taking this closing stock and we're putting it as opening stock, and this stock turns into sale. Not just this, but also there is so much of optimism and positivity when we lend money. Okay. When we lend money or we take up money, there's a time period that is given to us. So this concept simply states that you always have to make your or prepare your accounts with the mindset that your business is indefinite. There's no ending to it. Okay. Now let's go to the fourth concept, that is accounting period concept. All the transactions are recorded in the books of accounts on the assumption that profits on these transactions are to be ascertained for a specified period. This specified period is known as accounting period. Okay. This concept requires that a balance sheet and a profit and loss account should be prepared at regular intervals. Now see, generally an accounting period is taken for 12 months. Okay. Now that 12 months can start from 1st of April to 31st of March, or 1st of January to 31st of December. Okay. Now, why is it important to calculate a period? Because all the expenses and all the revenues that has been generated should be of the same period. Okay. So if you're spending some money, there has to be income getting generated. So you cannot spend money in some other accounting period and earn a revenue and show revenue in this accounting period. So simply it tells you that all your transactions should relate to one period while you're preparing your accounts. Okay. Now this is important because you generally prepare your accounts to know your financial position, to calculate profit, to calculate tax on your income. So for such purposes, it's important that you consider a certain period, and for that period you have to you have to make your accounts. Next concept, accounting cost concept. Now this concept simply says that all the assets that you're recording in your accounts has to be recorded on its cost. Now what is cost here? Cost is basically the acquisition, okay, the acquisition price, the transportation and the installation, okay, and not its market value or market price. So if you have purchased any kind of asset, that purchasing price would be the cost, and on that cost you will be noting it in the books of accounts. Now for example, I've bought an air conditioner, AC. Okay. When I have bought that AC, it costed me around, let's take 70,000. For that AC I paid, the money is 70,000. Now see, the air condition needs to be fitted in my house. It needs to be installed and then only it will work, right? I cannot get the air condition, keep it on the floor of my house and say that, okay, it's working. No, I have to properly install it. Let that be any kind of equipment, electronic, okay? Now, installation is necessary because the asset will not come under use if you don't install it. So if I'm saying 70,000 was the price of the air condition, and let's take installation charges is 10,000. Okay. So 70 plus 10 becomes 80. So if you have to write air conditioning cost in your balance sheet, you will write 80,000. Understood? So all the assets are going to be written on its cost. Fine. Now, next is dual aspect concept. Now, what is dual aspect concept? As the name suggests, dual means two. Okay. This concept assumes that every transaction has a dual effect. It affects two accounts in their respective opposite sides. Therefore, the transaction should be recorded at two places. It means both the aspects of the transaction must be recorded in the books of accounts. So every transaction has a debit and an equivalent credit. okay, or a credit and an equivalent debit. Thus, the duality concept is commonly expressed in terms of fundamental accounting equation. All of you must be knowing it. Asset is equal to liabilities plus capital. Therefore, students, that's why in the end, balance sheet tallies, right? Because we always see that asset is equal to liabilities plus capital. Okay. Now, the next concept is matching concept. Now, what is matching concept? The matching concept states that the revenue and the expenses incurred to earn the revenue must belong to the same accounting period. You just right now we saw a concept which is accounting period concept. There also I told you the same thing, that the revenue and the expenses should come from the same accounting period. So once the revenue is released, the next step is to allocate it to the relevant accounting period. Okay. And this can be done with the help of accrual concept. We'll study that ahead. If the revenue is more than the expenses, it is called as profit. If the expenses are more than the revenue, it's called as loss. This is what exactly has been done by applying the matching concept. Okay. Next is realization concept. This concept states that revenue from any business transaction should be included in the accounting records only when it is released. The term realization means creation of a legal right to receive money. Selling good is realization, receiving order is not. In other words, it can be said that revenue is said to have been released when cash has been received, or right to receive the cash on the sale of goods or services, or both has been created. Okay. So simply realization, the concept realization states that revenue is released at the time when goods or services are actually delivered. Okay. Now let's take an example here. A jeweler received an order to supply goods. Let's take a goods ornaments of worth rupees 5 lakhs. They supplied ornaments in this accounting period of rupees 2 lakh and up to the year ending 31st December 2005. Okay. The rest of the value of the ornaments, that is 3 lakh, it will be supplied in the upcoming accounting period. So when I close this accounting period, that is till December 31st December 2005, the revenue for the year of 2005 for the jeweler would be recorded as rupees 2 lakh and not 5 lakh. Okay. So merely getting an order for jewelry is not realization. Okay. When you got the money for it and you delivered the product, and now the person to whom you have delivered the product is liable to pay you, then it's called as realization. Okay. Okay, let's come to the next concept, that is accrual concept. The meaning of accrual is something that becomes due, especially an amount of money that is yet to be paid or received at the end of the accounting period. It means that revenues are recognized when they become receivable. Okay. Though cash is received or not received, and the expense are recognized when they become payable. So simply accounts, how we prepare accounts. While preparing your accounts, you always have to record an expense if you have to pay it, even though the money has gone or not gone. Okay. And you don't have to record the revenue if you have not received, even if it's receivable. Okay. So in the future, after 2-3 months, okay, yeah, this amount of money I'm going to get. Okay. But today you cannot show it as sale. You can show things at sale only when you have sold and the money, goods are delivered and the money you have received. Okay. So students, this was it for accounting concepts. Okay. Later, we'll be talking about accounting conventions. Now, further, if you want to know more about basics of accounting, you should refer to books like, there's one basic accounting books by Andy Lemmer and Nishat Hasmat. There's another book that is Bookkeeping and Accounting for Dummies by Jane E. Kelly. These books are like foundation of accounting. These books will give you a better idea about these accounting standards, concepts, conventions, principle, and you'll know more. You will be more stronger when it comes to the foundation. Okay. For this video, that's it. Thank you.